I'm standing here with our partner, Vina Jetty, on this 408 unit multifamily deal in Charlotte, North Carolina. And we're really excited to talk about it and get the questions answered about this deal. How is it acquired? What's the strategy? And what the heck does it actually mean to have a strategy behind, flipping or holding an asset this big? So Vina, thank you so much. First of all, where are we standing in this, apartment complex right now?
This is the model unit.
Okay.
So when we have a prospective tenant coming to see if they want to live here or not, this is the unit that we show them and give them the tour. So, we always want it staged, pretty. Yeah. We want it to be nicely decorated.
Like homey feeling, right?
Welcoming.
Now, looking at the deal itself, it's 408 units. Where did this deal come from? Like, how did you source this particular property?
So this deal was actually on market, so it was brought to us by a broker relationship we have here in the Charlotte market.
Okay.
We had to compete for it, so we had to bid against many other potential buyers, which is kind of the state of multifamily right now.
Now, when we're looking at this deal, what's going to be the strategy? Is this something that's going to be held for long term, or is this a deal where we come in, do some work and flip it, or what do you see as the best strategy for this property?
I think long-term or short-term depends on really who you're talking to, because when I talk to multifamily investors, I'm like, oh, this is a short-term hold, because we usually plan about a 5-year hold. But talking to a single-family flipper, they're like,
that's a
5 years. It's like a whole lifetime. So it depends who you're talking to, but generally our strategy is about 5 years on average is what we underwrite for and plan for.
Okay, so within that 5-year time frame, what's happening? Like, what's the plan within those 5 years?
So because we focus on value add, what we're going to do is we're going to go in and we're going to make all of our interior, exterior renovations. And typically what we'll do is we'll plan for that to be over the course of the first 18 months to 24 months, depending on the specific asset plan. So usually about 2 years to turn the units, and then what we'll do is we'll operate it to efficiency, and we'll make sure we restabilize after renovation. So then the next 3 years, usually we're kind of just getting the asset back up to stabilization and trying to push it and optimize it further. In this market, a lot of times we're seeing opportunities to exit early. So our last asset that we exited in 18 months. And we did not renovate all the units we had planned to, because we just simply didn't need to. So we reevaluate once we're in here and we're operating. And that's what our role is as sponsors on the deal.
Yeah, that makes sense. So as we're walking through this unit a little bit, it looks really nice. And you're mentioning doing renovation. So this is going to be a unit that you still want to renovate?
Yes.
And so what does that mean then? Like, we got granite countertops. Like, what's the type of work that'll be done here?
So first and foremost, not all of the units look like this. This is just the model. It's the nicer one, right? So we're going to bring all of the units up to a higher level. So for example, let's walk here. I'll show you in the bathroom, for example. We're going to switch out the countertops to granite, and then we'll reface or paint the cabinets. In some of the units, we might have to update the lighting fixtures or the shower fixtures. We may go to more green, low flow shower heads or low flow toilets, or adding aerators. So those are all things we look at and we evaluate. But one of the things that's important to note for value add is sometimes you go in with a plan and then you don't actually need to, or the market asks for something different. So it's also about adjusting to what the market is looking for and what the market needs. So it's not a rigid plan when we go in to do value add. It's a general plan, and then we have to constantly reevaluate.
Okay, got it. So essentially, with all the renovations that are going to be done, it'll look like this and or better, at the end of the day. And so
hopefully better.
Hopefully better, right? So when we're looking at that, then who's going to be the buyer at the end of this? Like, it's going to be stabilized. There's not going to be room for value add, because the value add has now been done. The property is going to be hopefully as close to fully rented. I mean, should it be at 100% rented, or what should the occupancy rate be when at the time that you exit?
So that's like the secret that people don't really realize when they're new, is you don't actually want a property to be 100% occupied.
Now, why is that?
Because if I have no units to rent you, and you come in, and let's say I rented the last unit at $1,500, how do I know if you would have paid $1,550 for it? So you're leaving money on the table because you have no availability. So when we're acquiring an asset, someone has 100% occupancy, we love that, because it just means it's opportunity for us to push rents higher. So really you want to maintain your occupancy at about 92 to 98%, depending on the asset. 95% is a good kind of middle of the road number.
Okay, that makes sense. So then who's going to be this buyer that we're going to be selling to in that up to 5 year time frame?
So on this size of asset, it's generally going to be an institutional buyer or a large family office that's going to buy it and hold it in their portfolio.
Okay.
And I think that's a really important point that you're asking me about this, and we just bought this asset, because when you go into these assets, you want to have an exit strategy.
Who is the person going to be, or company or entity going to be? Right?
Yeah, exactly. And you want to know who are the potential buyers, and if an institution won't buy this, is there someone else who could buy it? Can we keep it in our own portfolio? Can we recap our investors? There's so many different ways to exit, but you really want to think about all the ways that you can exit and what will be the most fruitful for your investors and their returns.
Okay, so when looking at a deal like this, for example, where it is the value add and then exit selling to an institutional buyer, why is that the strategy versus refinance into something long term and then holding it and letting the investor stay in it longer term? What's the...
That could be the exit on it. It's not necessarily that it has to be an exit. One of the things to give consideration to, though, is that on these types of assets, a little more than half of your return will generally come from the exit or the sale of the asset.
Oh, okay.
So do you want to keep the equity locked into the asset for a longer period of time? And again, it'll take some analysis, and this is why knowing your numbers is so important, because it will decrease your IRR the longer you hold the asset, because IRR is a function of time.
Okay, that makes sense. So it's basically turning the money faster so you can get access to that capital to then go redeploy it into another asset versus just tying it up for the long term. That makes sense. So if you're watching this video and you have questions about maybe getting started in your multifamily career, you can check out the other video that I did with Vina talking about what you would do if you were in your 20s and just getting started. If you're interested in investing in multifamily deals like this one, you can go to the link in the description below to invest in deals like this with myself and my business partner, Pace Morby. With that, we'll see you in the next video.